Good afternoon, everyone, and thank you for joining us for today's webinar, Preparing for the Reforms to the Australian Modern Slavery Act. My name is Catherine Flattery, LRQA Sales Manager for Australia and New Zealand, and I'll be guiding you through this session. The Australian Modern Slavery Act 2018 is undergoing significant reforms, including proposed civil penalties, expanded reporting obligations, and potential due diligence requirements. These changes will have a major impact on businesses, and today's discussion will help you understand what's likely to change, why it matters, and how to prepare. Over the next hour, we'll cover key changes and implications of the reforms, practical steps for risk assessments and supplier engagement, implementing due diligence across supply chains, reporting strategies and compliance readiness. We'll then conclude with a live Q&A, so please feel free to submit your questions throughout the session. Our first speaker is Alex Coward, Director from Pillar Two. Alex brings over 8 years of experience within the Australian government, where Alex helped shape the national response to modern slavery, including leading the development of the Modern Slavery Act and authoring the government's guidance. Alex is a recognised expert in supply chain transparency and co-author of benchmarking reports assessing ASX 200 companies' reporting quality. Our second speaker is Katie Udall, Director from LRQA Consulting APAC. Katie leads sustainability advisory across APAC and specialises in forced labour investigations and remediation. Katie regularly contributes to thought leadership on ethical sourcing and human rights due diligence. Our final speaker will be JP Stevenson, Chief Revenue Officer from LRQA EIQ. JP is a supply chain and technology executive based in Hong Kong. JP advises global companies on applying data for better risk management approaches and is a frequent speaker on ESG risk trends. With that, let's get started. Alex, I'll hand over to you to share an overview of the proposed reforms and what they mean for businesses.
Well, good afternoon, everyone. As you heard, I'm going to share some key context around the proposed reforms to the Modern Slavery Act. In particular, how we got here and the key developments along the way, the proposed changes to the reporting criteria set out in the Act, the potential proposals for a due diligence obligation and high-risk declarations, options for a penalty framework, and the potential next steps for government. So how did we get here? Well, the Australian Modern Slavery Act really had its genesis as early as 2012 and 2013, when in government we were discussing lessons learned from the Californian supply chains law a few years earlier. The Australian Modern Slavery Act was then developed and passed in 2018. It took effect in 2019. And the aim of the legislation, building on what we saw in California and in the United Kingdom, was to drive business action on modern slavery by requiring businesses to be transparent about the steps that they were taking. And the aim was that that information would then be used by the market, investors, other stakeholders to engage with companies on their responses and to drive good practice. Now, the Act itself required that after 3 years, it be reviewed to really test that assumption that transparency would drive change on the ground. That review took place over 2022, 2023, and it made 30 recommendations to the Australian government about steps that they could take to strengthen the legislation. Government considered those recommendations. They responded towards the end of 2024. And they agreed to make, or to at least explore, the changes that we're speaking about today. And we're now in the middle of a consultation process about those changes and the steps that government should take. And as businesses looking at this process, often a question is, well, why are we again doing a consultation process? Why have we got this fourth step and fourth box on the screen? And really, in simple terms, the way to think about it and to explain it internally in your business to the board and to other stakeholders is that the Modern Slavery Act review was to really work out what changes at a high level could be made. The government response was government confirming which of those actions it was going to take. And the current consultation is around the granular detail of how exactly those actions should be implemented. What should the words in the legislation say? Now, the first suite of changes that the government proposes to make are to the mandatory reporting criteria for content in the statement. And these criteria, for those of you who have reported under the legislation, are the criteria that tell you what you need to include in your modern slavery statements. And the major change here is to require companies to give more detail about the grievance mechanisms that you have in place, and also to require you to provide information about the processes and the actions that you've taken to remediate modern slavery incidents. Now, what this means for you as business is greater scrutiny on whether you're finding modern slavery, and if not, why not? And we know that that's been one of the key issues that our federal anti-slavery commissioner has really highlighted in his engagement with companies. And that includes questions like, are your grievance mechanisms fit for purpose? Do you know how you would remediate a modern slavery case in your supply chain where one might be identified? These aren't the only other changes to the reporting process. There's also a suite of technical changes that would apply to things like the way that groups of companies would report, where you might want to report voluntarily. There'll be some tweaks to that process as well. But the key message from the proposed changes to the reporting criteria is really that focus around grievance mechanisms and remediation processes. So the changes to the reporting criteria really focus on how to make the reporting model in the legislation as effective as possible. But the government is also exploring other options that go to whether there are things that they can add on or change to that core reporting model that sits within the Act. Now, the caveat here is that government has not been as strong in saying it will definitely take these forward. But the aim of the current consultations is to really test whether the two initiatives that you can see on the left of the screen would work in practice. Option one here is to expand the Modern Slavery Act, not only to require reporting, but also to require companies to undertake what we would call due diligence. And in other words, that's a requirement to take certain steps to identify, to act on, to communicate about, and to track the effectiveness of the steps that a business is taking to manage modern slavery risks. And many of you will have seen the term due diligence in the context of legislation in the EU, possible legislation closer to home in our region, including countries like South Korea and Thailand. And this proposed change has some really key implications for business. Some companies that are in the Australian market, particularly larger, more mature companies in higher risk sectors, may already be able to say that they're undertaking due diligence, they're carrying out those key steps that would be required. But there's other companies who may not yet be at that point. We also don't yet know what size companies the government might intend to cover with a due diligence requirement. It could be all companies that are currently covered by the Modern Slavery Act, but perhaps the more likely option is that government looks at a way to cover a smaller group of larger companies who might be more able to effectively implement these kinds of requirements. And the third key issue is what would happen where companies are then identified as having modern slavery in their supply chains, particularly if there might be questions about whether they've effectively applied the due diligence steps that they would be taking. And that leads into some quite complex conversations about issues like civil liability, where rights holders who might be workers in your supply chain or other stakeholders could be able to potentially take legal action to hold companies accountable. And those are all questions that government will need to keep working through. Option two is whether the government or perhaps our National Anti-Slavery Commissioner could declare certain products, services, sectors, or countries to be high risk for modern slavery. Now, that's not a forced labor import ban, as we see in the US and as we know is coming in the European Union, But there's certainly some stakeholders who might see this as a step in that direction. We also don't really know yet what the level of detail would be in a declaration, and also what companies would be required to do in response to a particular high-risk declaration. So if the government was in a position to say product X from region Y is high risk for modern slavery, what would it mean for a business to respond to that? And one example might be that companies would need to explicitly address that in their modern slavery reporting. Another key question is, well, how much evidence would government need to make a declaration about a high-risk product or service or sector? And would government ever be in a position where it feels comfortable associating those declarations with a particular country? And again, those are issues that the government is working through in consultations, but they will really significantly shape the way that as businesses, you might need to respond to these kinds of requests and declarations and the types of information that you might be expected to disclose in your public reporting. Now, the third area that government is looking at is around opportunities to introduce a penalty framework into the Modern Slavery Act. As it stands at the moment, our Modern Slavery Act doesn't include particular financial penalties for non-compliance. And government is looking at whether or not it could introduce those for potential offences like failing to report, including false or misleading information in statements, which might also be covered by existing corporate legislation. But beneath the surface, that question of penalties is actually quite a complex one. And the biggest question is, would a penalty framework actually drive the kind of change that we're wanting to see from companies as a sector? And the Act already actually empowers government to name and shame, in inverted commas, companies that are non-compliant. And so there's a conversation about whether that power, if it was used, which it hasn't been to date, might already be enough to drive change to business behaviours, and whether the time and resources that would be needed to establish a penalty framework with all the steps that would be involved, the costs of legal proceedings, etc., is proportionate to the kind of benefits that might drive. A penalty conversation is also a little bit simpler in the context of how businesses respond to the mandatory reporting criteria when you do your modern slavery statements as you're currently required to do. It becomes rather more challenging when you think about penalties in the context of due diligence, and if a company was found not to have taken the right due diligence steps, what kind of liability and consequences might that company experience? So in view of some of those complexities and issues, what happens next? Well, based on the public information we have, the timeline on the screen is my sense of what a likely timetable might be. The Australian government, of course, may move faster or slower than what I've suggested here. But to give you a sense of how the process will work, at the moment, the Attorney General's Department, AGD, is consulting with businesses and civil society about the issues that we've just talked through. You can join in those consultations through the email address on the screen. AGD will then have to agree an approach with other ministers and agencies across the government on those particular issues. They'll then draft legislation, introduce that legislation to Parliament. And then one of the really key points as you follow this process is that the Parliament and the government are, of course, distinct. And so the Parliament, where there are other parties, may wish to make particular amendments to the legislation that might not be amendments that government is putting forward. There'll be debates and votes on those. And where there's agreement, the bill would then pass the Parliament. At this point, the government consultations will continue until early 2026. Going forward from there, it seems unlikely that we'll have draft legislation in the Parliament until around the middle of the year. And from there, realistically, we're probably looking at the end of 2026 before we see legislation in whatever form it might take past the Parliament. But the key point from all of this is really that whether or not we have legislation around a due diligence requirement, high-risk declarations or other areas, the direction of travel that we have in Australia and overseas is really clear. Stakeholder expectations in this space are really clear, and it's important to be preparing for those irrespective of views that you might have about potential timelines or prospects for success of some of these initiatives. And so I'll pass to Katie now to share some more about some of the practical steps that you might take in preparation. And Katie, over to you.
Thanks very much, Alex. Yeah, I hope that was a useful intro for everyone to understand the changes to the regulation. I hope everyone can see my slides. Please flag if if you can't. Yeah, so as Alex walked us through there are a number of changes to the regulation that might be that might be coming through. I'm actually going to focus on the due diligence changes, because I think those are the ones that will be most impactful on organizations who have to report. I want to start by kind of looking at due diligence legislation globally. So there's definitely a rise of due diligence legislation across the globe. Alex mentioned the California Act there. There certainly have been a lot of legislation that have come into play in the last few years. There tends to be a bit of a difference between, or a distinction between the type of regulation that we're seeing emerging. There is disclosure regulation, which is what we're very used to seeing. A lot of stock exchanges already mandate disclosure, particularly around kind of general sustainability practices. Then the next bucket we have is due diligence, where organizations are expected to action and do more. And then we have actually a third bucket, which we're not going to talk about too much, but we have kind of a market access legislation, which is really the strongest legislation with the most teeth. But since what we're talking about with the Modern Slavery Act of Australia is it is moving potentially from the disclosure bucket into the due diligence bucket of legislation, that's kind of what I want to focus on a little bit today. So what's the practical difference between those two types of legislation? So disclosure tends to be a little passive. It tends to be, the aim of disclosure legislation is to encourage transparency. So it's to encourage organizations to talk about what they're doing, the challenges they're finding, the successes they're finding, be transparent about what it is that they're doing around modern slavery and sustainability in general. Often there's an ability to kind of be exempt from disclosure. I don't necessarily mean disclosure in general, but parts of the disclosure. So you can kind of say that there's aspects of this that are not relevant to you, or there's not much you're doing in this particular area right now. So there's a bit of flexibility around disclosure legislation. And then finally, the boundary of disclosure is often within your own sphere of control as a reporter, as an organization that's subject to these reporting requirements. Moving into the due diligence bucket, the legislation becomes a bit stronger. Due diligence is focused much more on action. And it really is the aim of due diligence type of regulation is for organizations to take accountability for the impacts that their organization is having, and also to move towards creating change and discussing and causing change to bring about improvements in not only their own performance, but the general landscape or business landscape. There's a requirement to take ownership, and often there isn't this option to kind of opt out. There is a need to disclose or to talk about or to conduct due diligence on all the aspects within that legislation. And often the boundary extends beyond your own sphere of control, actually throughout your whole value chain. So when I'm talking about value chain, this is a kind of an example chain of activities that you could be at any point in this value chain and still be affected by the other points of the value chain. So for example, you're one organization that is selling retail goods, selling apparel, selling various retail goods. Your supply chain very likely extends beyond Australia and New Zealand. It very likely extends into at least Southeast Asia, if not beyond. And so what that means is that when it comes to due diligence activities, you can't only focus on your own organization and your own activities anymore. A due diligence regulation, particularly one that includes supply chain responsibilities, which this likely will, means that you do need to be looking at your whole chain of activities. Even if you're somewhere in the middle, There may still be raw materials that you need to look into, and also looking ahead in your value chain as well. Do you need to be managing risk that's associated with all aspects of your value chain? So, as Alex touched on, due diligence, what that really means is not only reporting what you're currently doing, but actually taking action towards understanding what impacts you're having, understanding the risks that you're exposed to throughout your own operations and your supply chain, and then putting into place actions that manage and mitigate and reduce and remediate those risks. So this is a pretty simple kind of modern slavery due diligence activity or set of programs. This follows a lot of the guidance out there, such as the UN Guiding Principles, which is a really good and well accepted set of guidance for human rights due diligence. But this is kind of a simplified version. So what do you need to do? First of all, committing to modern slavery activities, human rights commitments throughout your supply chain in a public statement. A lot of you will be used to doing that already with the Modern Slavery Act, the current Modern Slavery Act regulations. So I'm not going to touch on that one too much today. The next step is certainly embedding those policies and those the sentiments of your public statement into your actual organization activities. So putting that into procedures, SOPs, and as a key part of that, training, awareness, and really making sure there is a culture shift towards managing human rights and modern slavery throughout all of your activities and your supply chain. Again, many of you may already have experience of that through kind of training and activities that you're already doing with the current regulations. So I'm going to focus more in the next 5 minutes on these two steps here: assess and engage. So certainly one of the key parts of a good due diligence program, and again, modern slavery requirements currently do ask for risk assessments, but the new regulations may go deeper and be more comprehensive around this. So I'm going to talk a bit about that. And this, once you've assessed and identified the risks in your own operations and your supply chain, the next step is to then engage with your stakeholders, your suppliers, to ensure that you are managing and remediating those risks. Finally, you come to reporting. So often I think when regulation comes out around reporting, organizations go straight to the report. What do we need to put into the report? But actually, particularly with something like a due diligence legislation, there are a lot of steps you need to go through before you can even reach that reporting step. So focusing on a kind of assess, and particularly risk assessment. Alex mentioned that was something that will be potentially in these new, strengthened in these new legislation. A risk-based approach to your supply chain management and your supplier engagement is really vital. You'll have hundreds, thousands, maybe hundreds of thousands suppliers in your supply chain. You can't manage all of them effectively in the same way. So getting a good understanding of where the risks are in your supply chain is a really key part of the start of a due diligence program design. There's a number of ways that you can do risk assessment. You can look at the landscape of your supply chain in general. Where are you buying goods from? Which geographic locations? And what goods are you buying? And then doing kind of some simple risk assessments on those locations and those products will give you a good idea of where the hot spots are for you, where potentially the biggest risks may be being posed to you through your activities and your supply chain. So that's kind of a general landscape overview, and you can do that without a really detailed understanding of your supply chain. So it's a great place to start if you're not quite ready to dive into specific supplier segmentation, which is the next step. So you can then look at specifically the suppliers that you are that you're engaging with, and identify which ones of those are associated with these risk hotspots, and then pulling out which of those suppliers you can really focus in on and how to deal with those. So we call this segmentation because you can end up with a certain set of suppliers in your value chain who are at this red section of the butterfly chart, who are your priority suppliers. Then you may have moderate suppliers, so those suppliers that pose a moderate level of risk to you. You may have suppliers who are more specialized in how you work with them. They may end up in this orange section of the graph, for example. And then you may have suppliers who pose a kind of a medium level of risk. In general, we find the ones landing in this kind of top red corner are the ones who are associated or there's a high reliance on lower skilled value sets within supply chains. So we're talking about manufacturing, food and beverage, agribusiness, where often workers in that supply chain, they might be foreign migrant workers, they might be workers who are more vulnerable to modern slavery issues and modern slavery abuses, for example. The ones that kind of more your white collar suppliers tend to be the ones that fall into the green area. So what this allows you to do is it allows you to be more strategic about your approach and your human rights and your modern slavery due diligence activities. So moving on from kind of once you've identified the risk, what do you do with that? So the suppliers and the organizations that you work with, your business partners who fall into that higher priority gap, those are the ones that you focus most of your efforts on, most of your supplier engagement efforts on. It might mean more regular engagement. It might mean a higher level of engagement. There's a whole few ways that you can kind of interpret what that might mean. But essentially, you now know that these are the suppliers you need to focus the majority of your supplier engagement efforts on. And the next level down, again, you can kind of step down your engagement slightly. You may only want to focus on critical issues, for example, and through the landscape review work that you would have done, you'll know what those critical issues are, and you can be very specific about the questions that you ask those suppliers to make sure that you are zoning in on the areas of a particular risk for you. Then you may have a group of suppliers who are more specialized, so maybe you want to look at more specialized type of engagement with those suppliers. And then finally, in the minimum box, it will be a very low touch type of engagement that you look at to put into place for those organizations in your supply chain. So what does that supplier engagement look like, or that organization engagement look like? I think people tend to move straight to audit. Let's audit these suppliers. And yes, auditing is definitely one of the important tools in your toolbox. And is a very useful way to understand and engage with suppliers. But it shouldn't be your only tool. It shouldn't be the only thing that you're using to engage with suppliers. There are a few other things that you can be doing to make sure your supplier engagement is effective at identifying and managing risk that they might be exposing you to. So first of all, looking at contract terms. So how are you contracting your suppliers? What does your supplier code of conduct look like? Are there already expectations in those contractual documents that set out what you need from your suppliers, what you expect from your suppliers to manage that modern slavery risk? So that's the kind of first part of that. Then taking a look at the ability of your suppliers to address those modern slavery risks. Are there suppliers who are already doing it very well? Are there suppliers who have less capacity to do so for a variety of reasons? And that might help you to further focus your efforts on these suppliers. There may be suppliers that need more support, need more help, in which case you can engage with them a little more closely. Developing a supplier capacity engagement or a supplier capacity development program is another really key part of this. I think, again, what a lot of organizations tend to feel is, well, it's the supplier's responsibility to figure these things out, but actually it's a risk to you as well. And so it makes much more sense for you to work together with your suppliers in a much more partnership type of way that helps them to manage the risks that they have, which reduces your exposure to those risks. So really seeing it as capacity development programs, engagement programs, rather than a kind of top-down auditing and scolding kind of program. And that leads to things like training. So providing training not only to your own staff, but also to suppliers. How can you make sure that what you are doing as a customer doesn't increase modern slavery risks or modern slavery issues within your supply chain, because there are a number of things that you might be doing as a customer that might be putting pressure on suppliers and forcing them towards making cutting corners, and those are the types of environments that lead to higher modern slavery risks. Communicating your needs and your expectations to suppliers, and then yes, auditing is something that should definitely be part of your toolbox, but really, as I said, only one part of that toolkit. Grievance mechanisms was called out by Alex, and yeah, grievance mechanisms are specifically called out potentially to be called out in the new legislation. And grievance mechanisms are also a really important part of a due diligence program. A number of different reasons for this: legal and regulatory compliance. So as I mentioned earlier, Australia is not the only country who may have due diligence legislation. There is already a number of due diligence legislation out there, and as part of that kind of global environment that most of us work in, you may already be needing to align with some of the other legal and regulatory compliance out there. So grievance mechanisms is also part of, for example, the EU triple D regulation as well, which is not yet in place, but potentially coming. What grievance mechanisms do is they allow you to proactively manage risk. So grievance mechanisms will allow workers to anonymously report grievances and issues that they're finding on the ground. And then you can get ahead of any, those blowing up and becoming bigger problems or bigger headaches by hearing about them and addressing them immediately. And then finally, another really important benefit of grievance mechanisms is improving worker satisfaction, retention, productivity. So this isn't just about managing risk, it's also about improving the environment that workers are in, and then holding on to those workers, the good workers that you want to hold on to, or that your suppliers want to hold on to, which obviously contribute to better performance, better products, better services in general. It's important that grievance mechanisms are anonymous and trusted by workers, otherwise they won't use them. There's no point just having a hotline that workers can send text to, but they don't get any feedback from that. They can't directly speak to someone to raise their grievances, and then no one can contact them to understand more about those grievances. So the quality of your grievance mechanism is also super important for how effective it is. So making sure that grievance mechanism is all of those things to be properly effective and useful for you to put the effort into. And then, of course, remediation. So once you understand the risk, you've worked with your suppliers, you're getting your audit results back, you're hearing from your grievance mechanism, you're hearing the kind of the grievances that are being reported. There needs to be a plan in place to remediate those issues that are coming through. So make sure you're taking accountability for those issues, remediating immediately, doing some further investigation into what those issues are, what's causing them, what are the root causes, and then put into place corrective action plans or remediation plans that can really effectively solve those issues, not just sticking a band-aid on and making sure that you pass the next audit, but making sure that those systemic issues are really well addressed and changed to make sure that there's a continued improvement within your supply chain and your risk exposure. I think that's all I had. So thank you very much for listening. I'm going to pass over to JP, and I'm happy to take any questions in the next section.
Wonderful. Thanks so much, Katie. And I'm so sorry for any of you that aren't able to see our screens. I understand we're having a little bit of a technical error right now. You should receive those shortly. One theme that I think we've all picked up on from Alex and Katie's talking points is that the challenge asked by new regulation is to find the right tool for the nature of the challenge. Be it running a modern slavery reporting process or looking at potentially how you go deep on an issue like forced labor. And thinking through what would be useful to understand, we thought we would ask the question, actually, what type of risks would Australian brands, companies, those involved in trade face if they were subject to the due diligence standards of other markets? So, like taking this from the lens of someone that has to report on, say, the CSDDD, or has a forced labor ban in place like UFLPA out of the US. What does risk look like today for Australian companies based upon the viewpoint that we have as one of the world's 4 largest social auditors on risk? And this is delivered through our tool EIQ. So with that lens, so if we look at Australia's main trade partners, we see, especially compared against, say, civil society disclosures, or even what you might see with mutual recognition scheme-based risk assessment processes, a number of salient human rights risks. So in the United States, and actually Japan, South Korea, China, Thailand, all of Australia's major trade partners, forced labor is really, really prevalent. In fact, in Western markets like the United States, we have been finding that there is high or extreme risks of forced labor, depending upon the region that you're looking at, for over 3-4 years now, well in advance of when the US government started to take an interest in cracking down on it. So I would say that the position of Australia today is maybe a little bit analogous to the position of the US then, where oftentimes risk is underreported because that hasn't because there hasn't been the same level of scrutiny as there might be, but that does not mean that it's not present. Few other callouts within these 5 markets. So we also see that forced labor risk oftentimes intersects with high or extreme levels of risk associated with migrant workers. I don't think that's particularly shocking for those that have seen this play out within Australia. Oftentimes, the way that workers are brought into the workforce can put them in potentially vulnerable positions. But what's also interesting to note is we rate the United States, South Korea, and Thailand as being at high or extreme levels of risk associated with freedom of association. And if you were taking this lens that Alex and Katie mentioned of evaluating whether or not your grievance mechanisms actually work, which is a key ask of the law, this is a really important point, because what we know is running grievance mechanisms in markets where freedom of association suffers. Generally, you don't have the same float of grievances that exist in areas where workers maybe feel they have more of an ability to report. And so I think that the call to action for this, in revisiting this theme of the right tool for the right challenge, is make sure your grievance mechanism is up to snuff in those markets, and potentially think about like actually how you would work with civil society organizations on ground to enhance the effectiveness of reporting, given that within those 3 markets in particular, there's probably more risk than in other markets that the grievance mechanism isn't operating in a way that it should. Now, forced labor risk generally is on the rise. We see this across all global production markets. We found instances of forced labor in over 40 countries, including Australia, including the United States, including the United Kingdom, including Italy last year. And I think there's a couple like higher level dynamics in trade playing out. So first, the trade environment now, as you all know, has been tough. Cost savings from suppliers in response to decoupling from traditional supply chain markets, the tariff environment have all placed cost pressures on workers ultimately that have potentially compromised their situation. Outside of that as well, we do see like elevated migrant worker dynamics, and especially given that in certain Western markets, these have been cracked down or scrutinized. I think that has created gray markets where more often than not there's more that we're not seeing versus in previous periods. The specific dynamics that we see taking shape with this is amongst foreign migrant workers. There's a pretty high risk associated with excessive recruitment fees and withholding of documents. But also we see within domestic migrant workers too, say if you're looking at China, for example, recruitment fees for health checkups have become pretty prevalent. Restricted access to basic amenities like toilet breaks and withholding of wage and documentation has also become more common than in previous years. If we look just within Australia, so for a number of years now, we have reported that Australia, like the US and other Western markets, is at high risk for forced labor, and this is driven by largely the migrant worker dynamic and Australia's policy framework. The point that I'd like to bring home here, though, is when we think about it in Australia, it's often framed just as being around ag context, which is not the case. Actually, we see forced labor playing out in construction, domestic work in particular. We see it very common in meat processing, aquaculture, cleaning and facilities, so your janitorial services, and also hospitality. I would also emphasize that this maybe is something that still, when we have client conversations, is not on the radar of many unless they've been directly exposed to it and ran an effective investigation and assessment of their risks. There is a little bit of an attitude of not in my backyard, but that's not necessarily consistent with what we are seeing. Um, I on the global trade environment and kind of how some of this has shifted recently. So tariffs, as mentioned, have complicated the situation by putting more cost pressure on sourcing markets. But I see two dynamics that are particularly complicated for looking at risk within Australian supply chains. The first is because y'all have not necessarily had a forced labor ban, and you operate in a politically different environment than a lot of the West. Capacity in markets like China that has been freed up because of some of this decoupling, because suppliers have been found to be problematic, has entered into the Australian market, in part because the pricing tends to be pretty effective with it. So while certain suppliers have been pulled back from by, say, American brands, Australian brands have maybe viewed this as an opportunity that they might not actually consider in that way were they operating under a different framing of the risk environment. The second thing that I would say too is, as a result of the tariff environment, we've also seen an additional layer of risk built into the supply chain. What we have found, dating back to the first U.S.-China trade war, is actually the tariff environment doesn't decouple you really from upstream risk. It increases the distance that your supply chain operates over. Normally, your final tier production will shift to, say, somewhere in Southeast Asia, even India. But the risk remains upstream much as it was, but you also now have the additional risk of having another facility in your supply chain that operates in a risk environment that is perhaps has a different set of drivers of risk than say just China. We ran a exercise in the lead up to this to actually look at just for 8 Australian companies that publicly disclose their suppliers. What actually we would find if we were to run a risk assessment tool in EIQ that is similar to what folks use in other markets. So we looked at 1,800 suppliers, and I just add too that Those that are publicly disclosing their suppliers are probably more aware of most of the problems of not having a great risk assessment process. And so this does maybe skew a little bit positive. But what we have found is amongst those 1,800 suppliers, there are about 240 incidences of risk associated with their supply chains or the upstream supply chain over a 3-year period. A lot of issues around wage violations and this is oftentimes stuff that would be reported out locally, say to a government-run grievance mechanism, but not captured within your audit process. Many complaints of freedom of association or suppression of freedom of association, inhumane treatment, many instances of worker strikes. But what was particularly striking is when we ran this assessment based upon the standards of the US and looked at Chinese suppliers that are potentially tied to forced labor allegations. And we found amongst all the hits, about 17% of the 242 incidences found were flags related specifically to forced labor. So Australian supply chains connected to forced labor, either through the ownership structure of the firm that was used as a part of the supply chain, upstream ties, say in your tier 2, so not maybe something that is immediately visible, and oftentimes participation in even entities that operate in Southeast Asia or outside on like the Eastern Chinese seaboard in economic development programs that involve labor transfers. And at least by the standards of other markets that have forced labor bans, when we see flags like that, it is normally taken seriously enough that the CBP in the case of the U.S. would issue a detainment of the container from entering into the country. This is all to say, operating in a regulated environment for this, fixing poor due diligence after it happens is 10 times more expensive than doing it right the first time. If we look at WROs that are issued out of the US, I mean, you're looking at oftentimes multi-million-dollar losses incurred from some of these problems, which ultimately originate in not having the correct risk assessment process. You face the loss of sale of goods from not being able to enter into the country with that container, or for other containers, if a WRO is issued. You face retailer and distributor fallout, reputational damages. So folks that experience a WRO normally take a 3 to 10% hit on their share price. You have the costs associated with managing the PR crisis, legal fees, product re-engineering associated with reconfiguring the supply chain, and also increased scrutiny and monitoring. All of this is to say that we do think with the right set of tools and the right set of processes, doesn't necessarily need to be ours. There's many approaches out there, but one that starts with a robust risk assessment based upon the industry's best data that flows through to thinking around how you choicefully use controls like audits, grievance mechanisms, or other monitoring frameworks as a part of your strategy for managing risk, but then also looking at remediation. You can have a process that works, yes, for what might change with Australia's law, but also is harmonized with the standards of most Western markets and what is now being expected. With that, we will conclude, and I'll pass it back over to Catherine to see if there are any questions.
Thanks, JP, and thank you to all our speakers for their insightful contributions. We'll now move into the Q&A session, so please feel free to share your questions in the chat. We'd love to hear from you. In the meantime, we'd also appreciate your feedback. Please take a moment to complete the quick survey using the QR code that hopefully you can see on your screen. JP, we might need you just to bring that up again. Thank you. Okay, so our first question relates to positive disclosure. The question is, what is the best approach for organisations to disclose incidents publicly in a way that builds trust? And how should boards be prepared to respond and lead during these disclosures?
Thanks, Catherine. I'm happy to take that question. Yeah, I think people, organizations, companies can sometimes be a little bit scared of disclosure because they feel it implicates them. They're worried about kind of saying things that they can't necessarily kind of back up. And yeah, putting their head above the parapet. I would say that disclosure in general is more positive than not disclosing, for sure. A lot of NGOs, a lot of investor ratings, etc. They look for public disclosure. So if you're not disclosing at all, you're going to have poor investor ratings, and you're also going to be more likely to be kind of spotlighted or highlighted when it comes to kind of NGO disclosures. Certainly, when organizations businesses are being seen to make the effort, it goes a long way towards improving relationships and reputations. And I would say, how can boards, how can they disclose in ways that builds trust? I would say, sorry, it's not an answer people like to hear, but prepare. Doing all this work, making sure that you're being proactive, having into place strategic programs to manage supplier risks, modern slavery risks, having due diligence activities. Those building blocks will give boards the comfort and the confidence to be able to talk and disclose in a way that they know what's happening, they know what they're doing, that they're doing what they can to manage these issues. And that's the best way that boards can be prepared to talk to their shareholders and other stakeholders, to really make sure they are being proactive and preparing themselves for these activities.
Excellent. Thank you, Katie. Our next question in the chat is, how will these reforms impact ESG reporting and investor expectations?
Alex, do you want to jump in? I can just very quickly say that it's definitely a reporting legislation, so there will be a lot of expectation around reporting. Investors absolutely use these reports to look at their to make investment decisions, some more than others, certainly. But yeah, there's definitely going to be an increase in making sure these disclosures and these activities are prioritizing ESG, sustainability, and obviously particularly modern slavery. I don't know, Alex, if you have a bit more to add to that.
Sure. So I think in the Australian context, the investor community is significantly more engaged with this issue than perhaps we've experienced in the UK, in Canada, and in other jurisdictions. So I think particularly from their perspective, together with stakeholders like the Federal Anti-Slavery Commissioner, we will see that increase in scrutiny around, are companies finding the risks that we know are there, and are they able to find and remediate where modern slavery is happening. Obviously, investors are going to be most relevant to larger publicly listed companies, but other stakeholders as well are looking at this. And here in Australia, for example, there's a number of benchmarks that track modern slavery reporting. These will definitely shape those. And I think the other point I would make is, as Katie spoke about with the network of global legislation, I think to some extent it's investor expectations and other stakeholder expectations that are helping to drive the changes here in Australia. So it's almost perhaps the inverse of that question.
Great, thank you both. The next question is, how should organisations communicate these changes to suppliers and partners to ensure alignment?
I'm happy to take that one again, but please, others do jump in. Yeah, so I think this goes back to one of my supplier engagement kind of key activities. Communicating expectations to suppliers is incredibly important, particularly your suppliers who are not within Australia, within the Australian context. So suppliers that are overseas, you may be surprised. They may already have a lot of these expectations from customers that are trading with other jurisdictions. So it may be something that's not a surprise to them that they can deal with quite easily. You may also find that that's not the case, and actually that it is quite a big change to them. It often some of these international regulations tend to be not necessarily aligned with local cultural norms. So I think those are some of the challenges that need to be navigated with suppliers that are outside of the Australian jurisdiction. So how do you communicate those things? I think there's a number of ways that you should. As I mentioned earlier, audit is just one of them, and really shouldn't be the first way that you communicate these expectations. Starting out with drafting your supplier codes of conduct, making sure suppliers understand them, not only sign them, but maybe some kind of trainings around them, conversations around them, onboarding of suppliers should also include really making sure they understand these expectations and what you need from them. But a two-way conversation, again, making sure that they have the capacity to support you on those things. And if they don't, what are some of the things that you can do to help them build that capacity to support you? We're certainly not an advocate for cutting out suppliers that can't align with things like modern slavery regulations. We're very much an advocate for helping out those other organizations, and particularly suppliers who might not have the capacity to deal with some of these kind of regulations that come from economically stronger countries. And so really making sure that as the customer, you have a responsibility to make sure your suppliers are not being put under undue stress and challenges which make modern slavery issues and risks, which magnify those even further. So codes of conduct, making sure those are clear. Trainings, there's a number of training programs that are already ready to go for suppliers. LRQA already has a bunch of those to plug us a little bit. So certainly in getting suppliers engaged with training programs, e-learnings can be really helpful. Also helping suppliers more directly by helping with supplier engagement programs in factories, on site, can also be really effective ways to make sure that you're communicating your needs with suppliers, and that they are communicating back what they need in order to make sure they are meeting those expectations.
Thanks, Katie. And just lastly, for smaller businesses, what practical steps can they take to meet the revised compliance standards without excessive cost? Have you got any tips there, any of the speakers?
So I think one first step, and Katie may have others as well, but anticipating the kinds of questions that you'll be asked by your larger corporate customers. So we know, for example, there'll be increasingly questions around the grievance mechanisms that you might have as a supplier, and being able to articulate your approach and explain what some of the opportunities, but also some of the challenges might be for you, so that you're then prepared to have those conversations with some of those key corporate customers.
Yeah, definitely. And I think trying to kind of rely on some of the industry movements that are happening. There are certainly organizations out there that are helping smaller suppliers to get on board. So really making sure you're looking for those resources out there. They are definitely out there. Organizations like the RBA, Responsible Business Alliance, for example, do have resources for smaller organizations that are ready to go and can be used. There's a load more organizations out there that have those kinds of resources available. So do look, they are out there. Rely on each other a little bit maybe as well, and kind of share experiences with each other, which can really reduce the amount of effort that you as an individual organization need to put in. And go back, go to your customers and say that you need help on X, Y, and Z. And hopefully if they're good customers and you're a good supplier, a good vendor, they'll be willing to help out with some of these challenges as well. But certainly it can seem a bit overwhelming for smaller organizations, but there is help out there.
Thank you very much. So that brings us to the end of our Q&A session. A big thank you again to our speakers for sharing such valuable insights, and to all of you for joining us today. We've covered the key reforms to the Australian Modern Slavery Act, practical steps for compliance, and strategies for strengthening, supply chain due diligence. These changes are significant, and early preparation, as we've heard today, will be critical for businesses to stay ahead. If you'd like to learn more or you need some tailored support, please visit our website at lrqa.com or reach out to our team directly. We'll also be sharing a recording of this session within a week. Before you leave, a reminder to please take a moment, if you haven't already, to scan the QR and complete the feedback survey. Your input helps us improve and deliver content that matters most to you. On behalf of LRQA and our speakers, thank you again for your time and participation. Stay informed, stay compliant, and we look forward to seeing you at future events. Have a great day.